How many of you have ever wanted more money for just about anything? I know that's every one of you. But in order for that to work, I gotta go over a couple things. First and most importantly, I gotta teach you how to take back control of your money. And I'm gonna do that by showing you how to be the bank. That's what we're gonna do today. We're gonna talk about your money, we're gonna talk about your wealth, and we're gonna talk about how you can live like the wealthy using their exact strategies. Now, this is a very simple thing that I'm gonna teach you, and it involves you changing one thing. That's it, just change one thing and add one step. I know all of you can do that, and that really is how simple it is. But first, I gotta teach you how to think differently, because everything you've been taught about money has been taught to you so that you give up control of your money. And that's where we're gonna begin. How to take back control of your money by you being your own bank. Before we get into how you're going to be your own bank, let me ask you for a favor. Right here, I need you to click that subscribe button. We want this to get out to as many people as possible. So while you're at it, right above, there's a little bell. That's right, smash that bell. So let's dive in. The first thing I always like to talk about is a study that was done in my favorite YouTube video, but it was done by Earl Nightingale, and it's called The Strangest Secret in the World. He goes into what the difference is between success and failure. And in this whole thing, he's talking about a study they did with 125-year-olds, and they did a study by asking them if they would be successful at the age of retirement. You already know the answer. Every one of those 125-year-olds said, yes, we're going to be successful. We're going to be millionaires. We're going to be wildly successful. But then the study tracks them all the way through to the age of 65, and something different happened. Now, before I tell you what the result is, and before I tell you the difference between success and failure, I want all of you to look at the screen right now. You are what I call the 5%. And you're the 5% because you're here right now. You're willing to learn something, and you're willing to apply this knowledge to change your financial life, because earlier I told you this is what we're doing. I'm teaching you how to mimic the wealthy. So you're the 5%, but let's snap back over to that study of those 125-year-olds. By the time they reached age 65, what the study showed is that only 5 of those 125-year-olds will be successful at the age of retirement. Now think about that. How is that even possible? This is the United States of America, the land of opportunity, the greatest country on earth. And only 5 of those eager, optimistic 125-year-olds are going to be successful? Well, you know what's funny? Look at the screen. This is Social Security Administration. It's right there. Only 5 out of 100 people will be financially secure at the age of retirement. And out of those 5, only 1 will be deemed as wealthy. So when we come back to Earl Nightingale's Strangest Secret in the World in the study, what was the difference between those 5 and the other 95? Those 5 were willing to create their financial futures. They were willing to create the dreams that they had. They were willing to follow through even against everybody else telling them they can't. So what happened to the 95%? The 95 that were not financially successful by the age of 65? It's easy. They conformed. They conformed to somebody's failed reality, somebody's failed dreams, and somebody's failed financial plans. You'll hear me recite Will Rogers a lot in this, but the one thing I want you to understand is that the biggest problem in America is not what you don't know. The biggest problem in this country is what you think you know that just ain't so. And we're gonna hit that heavily. But what we're gonna go over today is gonna force you to think differently. It's gonna force you to see outside the box. And I know this because I was the one that thought I knew what I didn't know. The first thing I want to get across is that I'm not the one that came up with this concept. This has been around for hundreds of years. This concept, which is called the infinite banking concept, has been talked about in many books. Look at the screen. Second Chance by Robert Kiyosaki. You've probably read his other book, Rich Dad, Poor Dad. Also, Tony Robbins, the big guy, yeah, his book, Money, Master the Game, section 5.2 talks all about the infinite banking concept. And then you've got the pioneer, the one who really brought this to light, Mr. R. Nelson Nash. I should say the late R. Nelson Nash. We lost him a few years ago, but he opened the door to what becoming your own bank really is and coined the term, the infinite banking concept. I've written several books. One right here, Mapping Out the Millionaire Mystery, which you got free just for watching this video. And then another book, Private Money Guide, which again, you can get for free. You see, this isn't something new. The families that have used this concept go back hundreds of years. And those family names you will know, such as the Rothschilds, the Rockefellers, the Morgans, the Stanleys. How about Walt Disney? How did he start Disneyland? Well, he used this. Ray Kroc, when he decided that the burger shop, McDonald's, was actually going to be a real estate company, he needed some money. And how did he do that? Well, he became his own bank by using this same concept. Keeps going on. Doris Christopher for Pampered Chef. Warren Buffett talks about it a lot. Then you've got McCain and Biden and all the politicians that use this. Love them or hate them, it doesn't matter. They are wealthy families that use what I'm about to teach you. The reason I'm laying all this out is because this has been around forever. So a lot of people, when they hear me tell them what this concept is, they say, oh, that's too good to be true. Oh, that must be a scam. There's no way this is real. Otherwise, I would have heard about it. But the reason you haven't heard about it is because the people that could teach this to you, the advisors, the agents, all the folks out there in the financial space, there's no financial benefit. Matter of fact, they'd have to take a 60 to 90% cut in their pay in order to help you do this. Why would they do that? So I always like to open up by asking you some questions, testing your knowledge about money. I call this the mysteries of money. So let's begin. First question, what is the definition of money? Now, many of you are thinking of different things. Feel free to put it down in the comments right now. We'll make this fun. But let me give you the definition. The definition of money is nothing more than a means of exchange. Money for food, food for money. Money for car, car for money. Money for house, house for money. It's just an exchange, and it doesn't matter whether the money's green or purple or red or gold coins. It's all the same. It's just an exchange. So if money is nothing more than a means of exchange, let's move on to the next question. What company in the world uses compound interest? Now this one, I know your answer, or at least most of your answers. It's banks, right? Banks use compound interest, but you see, the true answer to this question is none. There's not a business in the world that uses compound interest. So let's test that. When you put money into the bank, what does the bank do? Does the bank take your hard-earned dollars that you traded hours and hours for? Do they take your money, put it in a nice little box, close the top and put your name on it and store it in the vault? Is that how banks work? Oh no, folks. Banks charge you interest, and banks pay you interest. Banks do not use compound interest because banks keep their money in motion. So when you put money in the bank, they pay you interest on that money. And when you need money, the bank gives you back some of that money in the form of a loan, and they charge you interest on that money. And the amount that they pay you is always less than the amount they charge you. And in the middle is a magic word called a spread. The bank makes a spread on your money. But the one most important thing you must understand is that all money in the entire world must be in motion. So then answer me this riddle. Why do you have money sitting in a bank? Why do you have money sitting in a 401k? Why is your money just sitting there when banks and all the businesses like car dealerships and grocery stores are moving their money? Grocery stores are moving food off the shelves. Cars are moving cars off the lot. Every business everywhere is in the business of moving money except for you, because you've been taught to give up control of your money, park it with some other financial institution where they then will make that money go to work for them, and they will make a spread in doing that. Right there lies the secret. The secret to you becoming wealthy, because if you just learn how to take your money and keep it in motion, you will learn one of the most fundamental basics to how to grow money. And I'm going to teach you in just a second how to earn uninterrupted compound interest on your money, which means you can take the money and you can move that money any way you want while that money still earns compound interest. Wouldn't that be cool? So let's continue on with the mysteries of money. The next mystery is your money worth more today, or is it worth more in the future? Now, many of you would think, well, it'll be worth more in the future because it's going to grow, but really the true answer is your money will never be worth more than it is today. And I'll show you exactly why, because let's take a time trip back to 20 years ago. Ask yourself, how many candy bars could you buy for $1? And the answer will always be more than I can buy for $1 today. And that's because your dollars are worth the most today. When inflation hits your money, no matter whether it's in hyperinflation or just regular inflation, your money is losing value every single day. So with knowing that, the next mystery is, are taxes going up or are taxes going down? Well, that would require you to look at the tax rates in this country. And if you did that, or you read one of the many books about the tax rates in this country, you will see that we are at the lowest tax rates we have ever been at in our history, which then tells you that based on the amount of debt that this country has and the amount of debt the government has, there's only one path for taxes, and that is taxes are going up. But I'm sure all of you said that anyway, so kudos, you got that one right. But now let's go into one other thing. Qualified retirement plans. Your 401k, your 403b, your 457, your TSP, whatever you call your retirement plan, let me ask you a question. Why do you put money in it? And the answer I always get back is the same answer as to why I put money in a 401k many, many moons ago. My grandmother sat me down and said, Chris, when you get a job, ask them if they have a 401k. And I said, okay, Grandma. And then she said, and when they say that they have a 401k, ask them if they have a match. And I'm like, okay, Grandma. So when I entered Wall Street and I got that opportunity to ask, of course they had a 401k, and of course they matched 3% dollar for dollar. So how much money did I put in? Well, some of you might be thinking, well, if they matched 3%, you would have put 3% in. Wrong. I put 10% in. Why? Because I'm an overachiever. No. The reason why is because I was taught that the way you get ahead in life is by saving money, which it is. That's one piece. It's the first law of wealth. You must keep 10% of the money you make. But you see, when I put money in the 401k, I got a match up to 3%. So that was a good reason, but also that was pre-tax dollars. I didn't have to pay taxes on those dollars. Now, all of you are probably nodding your heads being like, yeah, those are the reasons I did mine. Yeah, and I had, I wanted to invest it. I wanted to retire someday. Great. Now let's go back to those mysteries of money we just went through. If you take your most valuable dollars, which are the dollars you have today, and you put them in a 401k, how long will that money have to sit there? 5, 10, 15, 20 years until you're 59 and a half? That's right, because prior to 59 and a half, you're going to pay a 10% IRS penalty. And in most qualified plans, you're going to pay taxes. But then we went on to say that there's not a business in the world that parks money and leaves it sit. That's right, their money's always in motion. So when you put money in your 401k, that money is sitting still. And who's using it? Well, the financial firm is putting it in some investment. And what are they doing? Charging you a fee or making a spread on the money. That's right. You see, they're doing the same things the banks were doing. But not only that, when you put money in that 401k, it was pre-tax. So you didn't have to pay tax on that money today at the lowest tax bracket. But yet you're agreeing that 5, 10, 15, 20 years, whatever that age is when you decide to start taking distributions from your 401k, you're going to pay a higher tax rate because you already said taxes are going up. So you just defied all the things you just told me were true about money. Money must be in motion. Your money's worth the most amount today. Taxes are going to go up in the future. All of those do not happen inside your 401k. But that's okay, because we've been taught to do things with money we would never do with things that money buys. Because think about this, would you ever go to the store and buy a nice Italian loaf of bread, come home, put that loaf of bread in the freezer, shut the door, and then wait 5, 10, 15 years, open the freezer back up, and lo and behold, right there in the freezer are 2 freezer-burned loaves of bread. Are you hungry now? Are you gonna take that loaf of bread out and be like, can't wait to eat this? But not only do you have 1, you have 2 because you got a match. Okay, would you ever buy your dream car? What is your dream car? Imagine that, get that visual. Would you buy your dream car? And right when you got the car delivered or picked it up from the dealership, go over to it, get in it, and just before you turn the key, you say, whoa, hang on a second. I gotta wait 5, 10, 15 years before I can enjoy this car because I gotta treat this car the same way I treat my money. Would you ever buy your dream house and you walk up to the front door the day you close with the key, with your significant other or your spouse, and you say, whoa, hold on, honey. I'm sorry. We can't move in for 5, 10, 15 years because I got to treat this house the same way I treat my money. Folks, I'm just trying to get you to start thinking about what you're doing with money and how it defies what you should be doing. I hope that wakes you up a little bit, but let's continue on. I know that was a lot that I just threw at you. but I need you to start seriously thinking about what you do with your money. Because up until this point, you've been taught to just accept the traditional way of thinking about money. But to truly build generational wealth, you need to challenge those old concepts and understand how money really works. So let's do another exercise, and this one's really fun, but it's gonna test your math skills. So are you ready? You pretty good at math? This one's called, How Does Your Money Flow? Now, I know all of you at one point or another have bought a car or will buy a car. So let's talk about the different ways you can buy a car. There are 4 distinct ways you can buy a car. Starting with, you can pay cash for a car. Okay, you save up enough money in a bank or somewhere else, and then you go and you pay cash for the car. And most people that do that, they save it up because they don't want a payment, and they don't want to give interest away to some other financial institution. The second way you can buy a car is you can always finance the car through a bank, in which you'll get approved for a loan, and then you will make monthly principal and interest payments in return for the ability to drive and own the car someday. And after the term is up, usually 5 years, you will then own the car, but you will have paid a bunch in interest to the bank for that car. And you now have an asset that has significantly depreciated, okay? Third way you can buy a car, and many of you probably have, you can lease a car. I still don't understand this, but yet I've done it. You make monthly payments of principal and interest to a financial institution, and then after like 3 years, 4 years, however long your lease term is, you just give the car back. That, to me, is one of the worst ways you can buy a car. But the fourth way, some of you, well, hopefully none of you have ever done this, but you could always steal the car. But what if I told you there was a fifth way to buy a car? A way in which you could get all the money back for every car you ever buy, drive, and own. Wouldn't you want to know about the fifth way? You absolutely would. So let me just go through and walk you through a traditional car buying experience. And I'm going to use one of you. If there's a Bob watching, Bob, you are my customer because you're going to buy a car. And Bob, look on the screen. You've saved $25,000 because that's what you needed to buy this new $25,000 car. Now, don't get hung up on the numbers. This is just an example. So Bob has saved up this $25,000, but see, Bob found himself a really good bank. And that really good bank paid him 4% on that $25,000. Now, since Bob found himself a really good bank, how about I play Bob's banker? So I'm banker Chris. Bob walks into this really good bank that's paying him 4% on his money, and Bob says, Chris, I need to take that $25,000 out of this really good bank that's paying me 4% because I'm buying a car and I want to pay cash for it. And banker Chris says, whoa, 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 Mr. Bob, hang on a second. How about this? How about this really good bank just makes you a loan for that new car for $25,000, and this bank will charge you 6% on that loan. Now, right off the bat, what are you all thinking? You think banker Chris made a good deal to Bob? No, because you're thinking, well, 6 is less than the 4 that the bank's paying, so you're upside down, Bob. Bob would lose 2% in that equation. But then banker Chris says to Bob, but Bob, if we do it this way and we give you that loan for $25,000 at 6%, your money will continue to stay in the bank and will serve as collateral, and it will continue to compound at 4%. And I can promise you, I will guarantee you, Bob, that this bank will pay you more money on your $25,000 earning 4% than you will ever pay this bank on that 6% $25,000 loan. Let me ask all of you, is banker Chris lying to Bob? Is it possible to earn more earning 4 when you're paying 6? And the answer that you're thinking right now in your mind is no. Absolutely not. Banker Chris is lying to Bob. I mean, 6 minus 4 is 2 by the math, and math doesn't lie. So let me put this to the test, because banker Chris is telling the truth. And if we just look at the math, the $25,000 loan at 6% for that 60 months, and it could be any time frame, doesn't change it, but we're going to do 60 months, Bob would pay $483.32 for that car loan. And over the course of the 60 months, the total future value that Bob would have paid to this really good bank is $28,999. 25 for the principal, the rest is interest. But then let's come over to the $25,000 that was earning 4% compounding in that really good bank. You see, over 60 months, if that money continued to compound, that money would have grown to be $30,500. $525. Now, unless we do math differently here in Buffalo, New York, that is $1,526 more that Bob made. So that little exercise proves that it is possible to earn more making 4% when you're paying 6%. But the question to you is why? Now think about that. It's very simple. The 4% is less than the 6%, yes, but the 4% was able to compound. So next year, that $25,000 was able to compound, not at $25,000, but at $25,000 plus the 4% interest. And every year over those 5 years, it was able to ratchet up because that's how compounding works. And let me just pause and bring note to one thing. So check this out. Albert Einstein, he was pretty good at math, right? Albert Einstein said that compound interest is the eighth wonder of the world. He said it's the most powerful thing in the financial world. But he then goes on to say those that understand it, earn it. Those that don't, pay it. Would you prefer to earn it or pay it? Of course you want to earn it. But what happened in this equation with Bob and banker Chris is that Bob took the loan from the bank because he went along with that guarantee that the banker said he would earn more on that 4% than he would ever pay on that 6% loan. And it's simple. You see, the 4% compounding on that $25,000, that money went up. When the loan at 6%, every payment he made on that loan brought the principal balance down, which meant every payment reduced the amount of interest that was being paid. So it's simple. One goes up and one goes down. Compounding interest plays a major factor in that. So now let's get into what the infinite banking concept is. But in order for me to tell you that, we have to understand the components of the infinite banking concepts. And first component that we must understand, we call this the money multiplier method, is we need a machine. That's right, remember I said it takes one change? And that one change, in order for you to become your own bank and take back control, is where your money goes first. So we need a machine because we can't use the traditional banks or Wall Street for your own banking system because they're in the business of making the spread. And I need you to be the one in control making the spread. So we got to change where your money goes first, and we're going to put it into a machine. So we have to identify a machine that will do all the things a traditional bank will not do, like pay you guaranteed interest, allow that interest to grow tax-free, pay you dividends every single year, protect you against creditors and judgments, allow that money to be used on an uninterrupted compounding basis. That's the machine we want. We'll get to that in a second. The second thing you must understand and must determine is that this is not a get-rich-quick thing. This is a marathon. You have to understand that life is not a sprint. You don't want to sprint through life. And getting wealthy and getting to the status of where the wealthy are, it takes time. It's a marathon. So now that I've got the bad news out of the way, the last thing that we need to understand is, what is your goal? What do you want? Because in order for the infinite banking concept to work, we have to have a goal, a problem to solve. Is your problem you want to be a millionaire? How about a billionaire? Great. That's a good starting place. Now let's reverse engineer that and figure out how that would be done. All three of these components, the machine, the marathon, the millionaire, all make up the money multiplier method. All right, so let's dive into the machine, the place where you're going to change where your money goes first. Because if you're going to be the bank, well, you can't use their bank. You got to create your own private banking system. And therefore, we need a machine where our money gets to flow through. That machine is going to pay you guaranteed interest. It's also going to pay you dividends every year. Although not guaranteed, every single year you should receive a dividend based on the fact that these companies have paid dividends for well over 100 years. Those dividends and that interest are going to grow in a tax-free environment as long as the machine is created properly, which we will do for you. Not only that, this money is going to grow and it's going to be protected from judgments and liens in most states. The best part about the machine we're going to use is it's going to allow your money to grow with compound interest, but uninterrupted, meaning you are going to be able to save money and use money at the same time, and you will not affect the eighth wonder of the world, compound interest. Not only that, there will be a benefit paid out the day you graduate and go on to a better place. So with all of that, what is the machine that we're talking about? The machine we're talking about is nothing other than a dividend-paying whole life insurance policy from a mutually owned insurance company.
Come on, you gotta be kidding me.
Are you serious, Grandpa?
Now, hold on a second, because I know what you're thinking. You're thinking what I thought the first time I was told this. I thought there ain't no way whole life does all that. And whole life is the worst place I can put my money, says Dave Ramsey and Susie Orman and so many others. So now you're telling me that the machine is going to be a whole life insurance policy? Well, before I told you what it was, did you not want all those things? Guaranteed interest, dividends, in a tax-free environment, able to use the money on an uninterrupted compounding basis, protected against judgments and liens, and the legacy play? You wanted all that, right? Well, there's only one vehicle, one machine on earth that can do all of that, and that's it. It is a whole life insurance policy. But to be clear, this is not your normal whole life that your brother-in-law tried selling you. This is a specially designed and engineered whole life that is built for the infinite banking concept. That's the difference. It's no different than a Ford Focus. Ford Focus is not a sexy car. But when you go into the dealership with your significant other and you say, oh my God, that's it, that's the car I want, it's a Ford Focus. Everybody thinks you're crazy because nobody thinks a Ford Focus is a sexy, awesome car. But when you watch YouTube and you watch the late Ken Block ripping around turns in his Ford Focus rally car at 130 miles an hour in full control, now that Ford Focus is a pretty cool car. What's the difference between the two Ford Focuses? Design and engineering. That is all. So when we talk about a whole life, all we're going to do is design and engineer it to do exactly what you're about to see. Do this. Google BOLI, B-O-L-I. I'll put it right on the board, B-O-L-I. You know what that stands for? Bank-owned life insurance. And when you do that, hundreds of pages will come up, but also you should be able to see a page from fdic.gov. Check it out right here. These are the top 5 banks in the country, and this is the amount of money that they have in, yes, none other than specially designed whole life. $75 billion. And that's just the top 5. And this is old data as of 2021, as you can see. So how much money do all the banks have? Well, it's in the trillions, folks. So when a bank wants you to put money in their CDs and their bank accounts, ask them to put you in the same place they put their tier 1 capital, and that is whole life. And also, the other reason we want to use whole life insurance as the machine is it's been around before the tax code. Actually, if you look at the tax code that was written in 1913, you will find that in the tax code are some very favorable tax treatments for life insurance. And back then, the only life insurance they had was whole life insurance. So therefore, you start to connect the dots. So you remember that prior example with Bob and the car and the really good bank where I played the banker? Well, if you really were to look at that, you see the really good bank that Bob found over here, that wasn't a bank at all, folks. That was a giant mutually owned insurance company. So Bob actually had the opportunity to be his own bank because his bank allowed him and his money to grow with compounding. You see, you're gonna see some things in just a second because I'm gonna show you how this machine and this process that I'm gonna teach you called the infinite banking concept will change your financial future. But just with cars, I'm gonna show you how to get all the money back for every single car you will ever buy, drive, and own. And to do that, all you gotta do is change one thing, folks, and that's where your money goes first. And then add one step, and that is called the infinite banking concepts. Let me show you. So you can make more earning 4% while you're paying 6% if you understand how money really works. And before I can teach you how to get all the money back for every car you're gonna buy, drive, and own, the first thing I want you to understand is banking. That's right, if you're gonna be your own bank, you need to know how banking works. So take a look at this screen. It's simple, right? We all know how this game works. You go out and you work for money, whether it's your business or you're working for somebody, but you make money and you put it into the bank. We already went over this, and the bank pays you interest. In this equation, 4%. Now, we already determined that banks don't just leave that money in a box with your name on it. Banks take that money and they move it in the form of loans. As a matter of fact, in the book Rich Dad Poor Dad, he talks about turning liabilities into assets. Banks are pros at this. Banks take your deposit, which is a liability to the bank, and they turn it into an asset by loaning that money out. And in this example, let's just assume they loan the money out to someone that wants to buy a home. When they lend the money on a home, and many of you have done this, what does the bank require? They require you to apply, get approved, and also put the house up for collateral in a mortgage. That mortgage secures the bank in a first lien position. So then once the mortgage is done, the money is paid out to who? Well, not you buying the house, it's paid out to the seller of the house. And what does the seller of the house do? Puts the money back into the bank. And then the bank takes that liability and turns that money into an asset by loaning it out on a car. In this example, a nice BMW M4. And what do they charge on that M4 loan? 8%. They charge 7 on the mortgage. Now they're charging 8 on the car loan. Why? Well, because a car is not as good of collateral as a house is. So they charge 1% more in this example. And the funny thing is these numbers are pretty close to what you would pay today. The car loan goes to the car dealer, but the bank takes a lien position on that title of the car, securing them with an asset like they did with the house. The car dealer puts the money back in the bank and immediately turns it back into a loan for a home remodel. Now, a lot of times a home remodel could be a HELOC loan, a home equity line of credit. That's a second position, which means more risk for the bank because they're not in first place. They're now in second position. Because of that, they charge 9% in this example. The contractor gets that money for the home remodel, puts it back in the bank lends it back out to somebody who needs to pay down their debts. And that's a debt consolidation loan, the only unsecured loan of the bunch. So that's heavily reliant on the person's personal financials. So they give that debt consolidation loan, it's 12%, the credit cards get the money and put the money back in the bank. We run around the circle here, but the question I have to ask you is who was in control of every one of those transactions? Was it you, because it was your money, remember you did the deposit, was it you in control? No, it was the bank who was in control of every one of those transactions. And how much risk did the bank take? The answer is not much, because the bank collateralized every one of those loans except for one, a mortgage, a lien on the car, a second position mortgage on that home remodel loan. The only one was the debt consolidation loan. So the bank did not take on much risk. And what did the bank earn on each one of those transactions? We covered this earlier. A spread. 4 minus 7 is 3. 8 minus 4 is 4. 9 minus 4 is 5. 12 minus 4 is 8. So you can see the bank made a spread on every one of those transactions that they were in control of, but they used your money. And in doing so, if we add those up, the bank made 20% and you made 4. Is that really the number though? Let me ask you, how much money in a percentage did the bank actually make on these transactions? I'll give you a second, but the answer will surprise you because the answer is 500% more than you made. And if we just look at the math, you made 4, they made 20, and the 20 was net of the 4 you made, and you divide 4 into 20, what is that? 5. The bank made 5 times more than you did, or 500% more than you made. And you know what? There's no surprise here. If you go to BauerFinancial.com and you put in any bank for any time frame, you will find that there's not a bank in this country that makes less than 400 to 1,300% on the money that you leave there. That's right. Banks are making 400 to 1,300% more than you because you gave up control of that money. And the bank knew how money worked and makes your money go to work for them. Now, that should really upset you, but that should also motivate you to take action. So let's do that. So let's move on to what we call the annual pattern of spending. And I think this represents one of the biggest problems most of our members face. So we have our community member, we call it our campfire. You are now taking the first step of getting around our campfire, and I want to preface this. The fastest way for you to build wealth is through your own debts and expenses. And one of the biggest mistakes people make is they rack up all sorts of debts, and yet they do save money, usually in the wrong place, the bank, the 401k, the brokerage accounts, but they save money, but then they got money that they're saving and they got all the debts they're paying and they still never feel like they're getting ahead because they're not. So you want to know the fastest way to wealth? Look at your debts. And imagine how much more money would you have if every check that you write to somebody else was a check that you wrote to yourself. It'd be a lot more, right? Well, let me show you how much more. If I take $1 and I break it up for all the expenses, automobiles make up about 20 cents of every dollar. Housing makes up 30 cents of every dollar. Everything else, diapers, groceries, going out, all that stuff makes up 40 cents of every single dollar, which leaves 10% for savings, which is law number 1 of wealth. You must keep 10% of what you make. However, in this country, as of 2023, the savings rate is way less than 10%. But that's where it should be, and that is the annual pattern of spending. But again, remember I said, what if you just wrote all the checks that you write for your car payments, your mortgage payments, and everything else, including all those credit cards, those loan payments? What if you wrote all those checks back to yourself? What would it look like? Well, let me show you. Because as of 18 months ago, the average savings rate was less than 5%. So we need to change that. But the best way to change the amount you save is not always working harder, working longer, and taking on more risk. The best way is to take back the money you're giving away. And that's what we're gonna do here. So when we look at that savings, it was 10%. But we looked at the automobiles, and that was 20 cents. Or 20%. On average, people spend 20 cents of every dollar they earn on their car. Out of that 20 cents, 5 cents of it is interest. So if we were to remove this 5% from the auto's 20% that you spend and move it to your savings, essentially what we have done is increased your savings by 50%. That's pretty cool, right? Now, don't get caught up in how this is gonna happen. I'll show you that in a second. But let's talk interest. Even if you pay cash for a car, you take that $25,000 out of the bank and you take it to the dealership, and then the dealership has your money. That money no longer works for you. That money no longer can earn interest for you anymore. So when you pay cash for a car, you might think that's the best way to go, but you're actually hurting yourself because you're losing the earning potential on that $25,000 car. You're either making one large payment or 25 smaller payments. $25,000 once versus $1,000 a month for 25 months. You get where I'm going? You also have just given up the interest that you could have earned on that $25,000, plus the money is gone from your family forever. You're also going to have another car in the future, which poses the next problem. But let's move on past that. People spend an average of 30 cents on housing, of which 25 cents of that is interest. See, if you move that 25 cents over to your savings, well, that would make a really big difference. You see, own equals all of your money goes to the mortgage company. So when I say that, on your most recent mortgage statement, I want you to look at the interest portion. I want you to look at how much that is. So in the first 7 years of any mortgage, roughly about 80% or more of your payment goes to interest. So therefore, in the first 5 to 7 years that you're in a home, the majority of the money you pay for that home does not reduce your principal. It pays all the interest to the bank. You see, the banks understand the volume of interest, and we get hung up on the rate. But it's not the rate that you should be worried about. It's not even the interest rate you should be worried about. It's the volume of interest that you're paying in the first 7 years that you need to be interested in. You see, if you're renting, because some people would say, oh, I better rent then. 100% of your money is going out the door, and you'll never see it again. Folks, I'm just trying to get you to wake up and see what's really going on with your money. So let's move on to everything else. 40 cents of every dollar is spent on living expenses, which is roughly about 5 cents of that 40 going to interest. So let me ask you, what if you knew how to get all the money back for all the products and services and the things you buy? Wouldn't that be pretty cool? Well, when we look at the screen right here, all we did is we took back control of all the money. We no longer send the money out to everybody else. We actually take and send the money back to our savings. This is how you build wealth through your own debts and expenses. But as you can probably imagine, this takes time. So let's get into something that's really fun. Some of you have been waiting for this. This is how you get all the money back for every car you're ever going to buy, drive, and own. But let's go back to the machine real quick, because you're still hung up on that machine, that specially designed whole life. And you're probably hung up on a couple things. You think of the premiums. Oh, premiums are bad, just like your car insurance or your home insurance. You hate making insurance payments because that money's gone, it's an expense. But you love making deposits in your bank. And when you make deposits in your bank, doesn't that feel good? So when we make premium deposits into the specially designed whole life, you are indeed capitalizing your private banking system by funding that whole life insurance policy. Because remember I said it's specially designed and engineered, so it does not function the exact same way a regular whole life works. The next thing, some of you are probably saying, oh, I'm too old. Whole life insurance, the cost is too much at my age. Wrong. Age doesn't matter in this sense because we're not building the policy for death benefit, and death benefit is where the age matters. We're reducing the death benefit to the lowest amount required by the IRS. They call it the MEC 7 pay. So when we build the whole life, we're actually putting the lowest death benefit on, and we're taking the majority of the premium deposit and we're putting it into a special rider called a PUA rider, which means that money gets to grow for you on a complete uninterrupted compounding basis. But if we took a 30-year-old and a 60-year-old and we did the same exact policy with the same exact design, the one thing that would not change much is the cash value that either of them have. But what the difference would be is the 60-year-old would have a significantly lower death benefit than the 30-year-old. So, therefore, age doesn't matter. Moving on to the last thing, death benefit. I already covered this. The death benefit is reduced to the lowest amount required by the MEC 7 pay rule, the IRS limits. And by doing that, we reduce the cost in the whole life, allowing more of the money, a majority of the money, anywhere between 60 and 90% to go directly to that special rider called the paid up additions rider, so it works for you. Now, some of you are glazing over and you're saying that's too much information. Just show me how to get the money back for the car. Great, let's do that. So in order to buy a car with your own private banking system and then to use the infinite banking concept, you would have to agree we would have to capitalize your banking system. Just like Bob had to save up that money to buy the car in the earlier example, you got to capitalize your banking system. So for today's example, I'm going to show you capitalizing your banking system with $10,000 premium deposits each year. Now don't get hung up on the numbers. They can be any number you want. Matter of fact, the minimum for you to set up your infinite banking concept would be 10 times your age. Now, what does that mean? Well, I'm 46 years old, so if I add a 0 to my age, that's $460. That's the minimum monthly amount in order for this to work. So when I say 10,000, I'm just picking a number that's nice and easy for division and multiplication. But your number could be significantly different. Your number could be 5,000 a year. Your number could be 5 million a year. You see, we design the policy based on the amount you want to save in your private banking system. So in this case, for this example, we're going to save $10,000 a year in premium deposits. Now, if I put over here the cash value in the money multiplier account, you will see that in the first year, if we put $10,000 in, we have just shy of $6,000 available. The second year, we put $10,000 in this example, and you have $12,000, a little more. In the third year, you put $10,000 in, and you have $29,204. So in the third year, what we're going to do is we're going to buy a car. We're going to buy a $25,000 automobile. Again, if the numbers don't work for the car you want, add a 0 and go buy that Ferrari you want, but add a 0 to the amount you saved as well. But the $25,000 that we took out of that cash value money multiplier account really never left the account. So in the third year, even though you took $25,000 out, you still have $29,204 earning uninterrupted compounding interest, which means you're getting paid a guaranteed interest rate plus a dividend from the insurance company, and that money's still in there compounding. So whose $25,000 did we use to buy the car? Well, we used the insurance company's money. The insurance company gladly would lend us our death benefit while we're living. Because remember, there's two promises the insurance company gives you. One, they'll pay you a guaranteed interest rate, and number two, they're gonna pay a death benefit out when you graduate and go on to heaven. But that death benefit doesn't only have to be paid out when you die. You can use that money while you live, up to the amount of cash value that you have, because the insurance company is going to collateralize that $25,000 loan with the cash value that you have built up. So now you understand how you earn uninterrupted compound interest. You're using the death benefit early, and the insurance company is charging you interest on that loan. But the interest and dividends you're earning on the cash value, uninterrupted compounding, that is more than what you're actually being charged by the insurance company on that loan of them advancing your death benefit. So now that you understand why we use this machine from a standpoint of compounding and also the ability for your money to work for you for the rest of your life, now we gotta apply the process. So we changed where the money went. Now we have to add one more step. Remember I told you I'm gonna teach you how to be the bank. And if I'm gonna teach you how to be the bank, that means you gotta be an honest banker. You gotta treat your money the same way you would treat a traditional bank's money, which means you normally would make a monthly payment to a traditional bank for a car loan, right? So you took a loan from your private bank, so you don't want to steal that money. So what you're going to do is figure out exactly how much that payment would have been with someone else's bank. And you remember we did the math. It was $483. I'm going to round it up to $500 a month, just for simple math. You're going to make a $500 a month car payment, but you're not going to make it to somebody else's bank. You're going to make that car payment back to your private bank, which is that specially designed whole life. So when you do that, $500 makes its way back into your policy. It reduces that loan that the insurance company advanced you. And by the way, the loan never needs to be paid back because it's in advance of your death benefit. The insurance company will be paid back the loan the day you die if you didn't pay it back. But I'm teaching you the infinite banking concept, which means we're gonna be an honest banker and we're gonna make $500 a month payments back to your bank, because I'm gonna show you this is the best way for you to build wealth and get all the money back for every car you buy, drive, and own. So let's get into the math now that you know what's going on. So for 7 years in this example, we saved $10,000 in that specially designed whole life. And we then took and paid back our policy $500 a month, which is $6,000 a year. So if we do that times the 5 years that we made those car payments back to our policy, that's $30,000. So if we add $70,000, your premium deposits, that was the capitalization of your bank, and we add the $30,000 in car loan payments you made back, that's $100,000. But then what we did is we took out $25,000 to buy the car. So if we do 100 minus 25,000, that means our true net injection into your private banking system is 75,000. Now, let's go over what happened in this first 7 years. You saved money, you used the infinite banking concept and that specially designed whole life. So what happened at the end of it? Well, first off, the car that's in the driveway is bought and paid for. Second off, if you look at your cash value in year 7, that is $67,881. If you put $75,000 into your banking system and you got $67,881 still in your policy, that means that you got 91 cents of every dollar back for that first car that you bought. That's pretty impressive. I bet you nobody watching this video right now knows how to get 91 cents back of every dollar that you pay for a car unless you sell the car. But indeed, in this scenario, you didn't have to sell the car. You just got 91 cents of every dollar back. But you see, there's something that happens when a car hits 5 years old. The brakes start to go, your tires are probably bald, your car starts to break down. So what do? Well, we buy another car. So what we're gonna do is in year 8, we're gonna do the exact same thing. We're gonna repeat the process. We're gonna buy another car. But what we're not gonna do, and this is just for examples, we would never tell you to stop making premium deposits into your banking system. But for this example, we're not gonna make any more premium deposits from years 8 through 12. Not another dollar is going to be saved. But we're still going to take $25,000 out in that 8th year and we're going to buy another car. And then we're going to make $500 payments back to that policy, repaying the loan that you took from your death benefit. So if we do the math here, there's 0 new deposits. You repaid $30,000 for that second car you bought, so that's 30 grand, but we subtract 25,000 for the purchase of the car. So 30 minus 25 means in years 8 through 12, your true net injection into your banking system is $5,000. If we look up to the cash value in your money multiplier account in year 12, it is $91,473. In year 7, you had $67,881. If we subtract the 2, that means you made $23,592 for buying 2 cars. And both cars are now bought and paid for in the driveway. But you see, you didn't make $23,592. That's just how much your account grew. If we look at your true net injection from the first 7 years, it was $75,000. In the next 5 years was $5,000. So 75 plus 5 is how much? $80,000. So if we look at your cash value of $91,473 and we subtract your true net injection of $80,000, how much did you make for buying 2 cars? $11,473 is the amount that you made for buying 2 cars, which are now in the driveway, which still have value, and you could sell tomorrow or gift or give away or let your kids drive. So now I have effectively showed you where your money is going to go, that one change. I've shown you what that second thing is that you're going to apply, which is the infinite banking concept. I now showed you how to get all the money back for every car you ever buy, drive, and own, but there was some rules you had to follow. There were specifically 3 different rules to make that work. So let's just cover the 3 rules. First off, you had to pay yourself first, didn't you? You had to save that money to capitalize your bank. The second rule is you had to pay yourself with interest. You see, when you took the loan from your bank, you repaid that loan with interest, the same way you would do it with any traditional bank or any finance company that you have ever borrowed money from. You're just being an honest banker. Number 3, you recycled and recaptured all the money you used to give away. So what does that mean? Well, the way you buy cars today, whether it's a lease or a finance, you give that money away every month. You recycled and recaptured that. Although you made monthly payments back to your policy, I want you to be aware that every dollar that you repaid back to your policy is money that you had to use the next day. You see, when you make a car payment now, if it was a $500 car payment to a traditional bank, you can't go back to the bank and say, hey, I need that $500 back. I kind of had an emergency. But when it's your private banking system, like I just taught you, that $500 is in your cash value the moment your check clears. And all you had to do is follow 3 separate rules. If it works for a car, what else does it work for? Well, it works for everything, folks. But let's move on to what I think is one of the biggest problems in this country, and that's debts. You see, if you look at statistics, as of 2023, credit card debts have reached all-time highs. So I'm going to refer to a real case study of a chiropractor that came to us after watching a video very much like what you're seeing. He came to us and he said, can you help me? And we said, sure, what's your scenario? Well, he said, here are all my debts. You can see them on the screen right here. He had 9 third-party debts totaling $478,774. He was making payments every single month to somebody else's bank, all listed there, of $5,777 every single month. That's $69,324 a year he was giving away that would never come back to his family ever. And he said, how can you help me take back control of this money? We first said, okay, Mr. Chiropractor, how much money are you saving today? He did some calculations and he said, between my 401k and my savings accounts, I save about, well, it was a little more, but about $25,000 every year. And then what I said is, I said, what if all we did is we stopped saving for a little, we took the $25,000 and we paid down your debts with that money? Seems logical, right? How long would it take for us to pay off all of these debts on their current payment schedules? The answer, 19 years by the math. That was unacceptable. So we said, well, what if we change one thing, Mr. Chiropractor, and that is where your money goes first. What if we put that money into a machine, a specially designed whole life, and then we add one step and we apply the infinite banking concept? How long will it take to pay off Mr. Chiropractor's debt? The answer, 6.5 years. Let me walk you through how this worked. So the first year, the simple change was we set up a specially designed whole life for this chiropractor. And we put that $25,000 deposit into that whole life. And when we did that, we immediately took a loan out in the first 30 days. Let me repeat that. He put $25,000 into premium deposits into that policy. We immediately took a loan from the policy in the first 30 days. And that loan amount was for $14,863. We took the $14,863 and we paid off Discover. We paid off Lowe's. We paid down Nordstrom, which means we reduced his debts from $57.77 a month to $53.29, which means that freed up $448 every single month. We said, Mr. Chiropractor, we need you to go to your local bank, wherever you do your banking, we need you to open up a second checking account. We're gonna call this your segregated account. And we want you to save that $448 that you used to give away to Discover and Lowe's every month, put that in this newly created checking account called your segregated account. Everybody's tracking what I'm doing here, right? Nothing hard about this, nothing complicated at all. Second year, what are we gonna do? We're gonna do the same exact thing. We're gonna take the $25,000, put it into the policy. We're immediately gonna take $16,571 out in the first 30 days. It's more than it was the first year because now you're compounding. So we take $16,571 out of the policy as a loan, and we also have saved in that separate bank account $5,374. That's a total of $21,945 in the second year. So what do we do with that $21,945? Well, we're gonna pay off Nordstrom, we're gonna pay off Wells Fargo, we're gonna pay off the private loan, we're gonna pay down BMW. His current debts in year 2 are $378,013. His monthly payments are now not $53.29, they're now $38.60 every month, which means he now has the ability to recycle and recapture $1,917, which is money he gave away to Discover, Lowe's, Nordstrom, Wells Fargo, and the private loan. He just did this every month. Now, he still makes those payments, but he pays them back to himself in that segregated account. So year 3. Year 3 is always a magical year for most of our members. And the reason for that is, in this scenario, the chiropractor put $25,000 in, and how much was he able to take out immediately in the first 30 days? More than $25,000. You see, now the compounding caught up, and he's able to take $25,541. Now let me pause for a second. You understand that in the first 2 years, the amount of money the chiropractor put into the policy was not able to use 100% of the money. Matter of fact, in this example, which is a bad example because the one we would design for you in today's world is going to be far better than this. But in this example, for the first 2 years, he had less money than what he put in. But the third year represents what we call the efficiency point. It is the point in which the policy, the money you put in that year, you're able to take out more than what you put in. And that means that now your compounding interest has reached a point where it is working in your favor. But for the first 2 years, this client lost money. For some of you, that's not acceptable. But for this client and all the thousands of clients we have, they accept that because they also get a death benefit. And the death benefit does cost money. Insurance companies are not nonprofit. So the amount that is paid for the death benefit really shows its ugly face in the first 2 years, like you saw. But now the third year, we have broken even on the cash-on-cash return. So that $25,541 plus, he was saving $1,917 a month in that segregated account. If we add both of those together, we had $48,545 in the total amount we can use. So what are we gonna do with that? We're gonna pay off the rest of that BMW loan. We're gonna pay down that West Marine boat loan. We're gonna pay down the condo. So 3 years into this, the chiropractor now only owes $283,146. His $2,100, and the amount he's recycling and recapturing into that segregated account is now $36.77 a month. Folks, this chiropractor did not have to work harder, this chiropractor did not have to work longer, and this chiropractor did not have to take on any additional risk. All he did is changed one thing, where his money went first, and applied this process. So realistically, that's the marathon that I talked about early on. The marathon looks like this. How much money did he put into the policy? Year 1, 25, year 2, 25, year 3, 25. He put $75,000 in the policy. But every year, immediately in the first 30 days, we took loans from the policy. $14,000, $16,000, and $25,000 over 3 years. That's $55,000. How much money is left in his policy? Well, for many of you, you take the 75 minus the 55 and you think that there's 20,000 left. But you're wrong. There's 75,000 left. Remember, we're not taking our money, we're taking a loan from the insurance company. We're just using our money as collateral. So as we move on, now we're on year 4. What are we gonna do in year 4? The same we did in all the other years. We're gonna deposit $25,000 in premium deposits. We're immediately gonna take a loan from the policy in the first 30 days, and that's gonna be $26,304. But we were saving $3,677 a month in that segregated bank account. And just for the record, that segregated bank account, should this chiropractor have had an emergency or something come up, that money's liquid, and so is the cash value. So if the chiropractor couldn't have stuck to this initial plan that we designed for him in our mapping process, this chiropractor would have just taken longer to pay off all the debt. But he did stick to the plan. So totaling up the segregated account, which is $44,124, plus the cash value loan, which is $26,304, he had $70,439. So what are we going to do with that? We're going to take that $70,000, we're going to pay down that condo mortgage. But by paying the condo mortgage down, we didn't reduce the amount he owed to the banks because these are mortgages. When you make a principal payment, it doesn't reduce the monthly payment. So his monthly payment to other banks is $2,100. The amount he's recycling and recapturing remains the same at $36.77, but now, year 4, he only owes $187,515. So year 5, we do the same thing. $25,000 goes into the policy. $27,090 immediately is taken out as a loan in the first 30 days. We saved $44,124 in the segregated account over the 12 months of year 5, so we have $71,225. So what we do with that is we pay off the condo, we pay down his primary house, so now, year 5, he owes $91,099. Not too bad at all. But the monthly payment that's being made to other banks is now only $1,221, and the amount that he's recycling and recapturing is $4,556. That's only 5 years into what would have taken him 19 years doing it the old-fashioned way. Not bad. But the 6th year, something happens. You see, there's rules for this. He was putting $25,000 into the policy, and in his first policy, he hit his MEC limit. Now, today, the way we design policies, we have 10 years we can do this for. But back when we did his, the 6th year was the year he could no longer put $25,000 into the policy because he hit his limit. He could only put $10,000 in that first policy. But when he took the loan out immediately in the first 30 days, it was $13,092. Hold on a second. He put $10,000 in premium deposits in that policy in the 6th year, and he took $13,092 out? What's his cash on cash return on that? For any of you that said over 30%, you're right. That's how much he made because of compound interest over 6 years on the original cash value balances. That's the power of compounding interest. So he was so excited about that, he opened his second branch office. In other words, his second policy, in which he deposited $25,000 into that second policy. So he took $13,992 out of the first one, $14,863 out of the second one, both immediately in the first 30 days, and he recaptured $45.56 a month in that segregated account. So how much did he save? $54,678 in that segregated account. That's a total of $82,633, and as you can see, the only mortgage left is $76,450. So 6.5 years later, he paid off all of his debts. He's now got $57.77 a month getting saved in that segregated account, which he's then going to take and use that money to repay the loans to the policy so that all the money is reinstated, so he's not paying interest on those loans to the insurance company. All the while, he's been making uninterrupted compounding interest on all of his money, and he's debt-free 6.5 years later. You see, the complicated part about that is really nothing. There's nothing difficult, except for it would take time to manage all of that year in and year out. So this slide right here represents what we call the debt map. We do this for our clients. For every one of our over 6,000 clients in this country, we do a mapping call. We work with our clients to solve their problems. We create a map. It's kind of like your GPS. You give us the destination, and we create the GPS, the map, so that you get there. And we work with you on a quarterly basis to make sure you stay on track or to make changes as those changes are needed. Folks, I have literally just shown you one of the biggest secrets when it comes to wealth. We only talked about cars and debts, and there's so much more. That's why it's called the infinite banking concept. But we needed a goal. Whether it's buying cars, paying down debts, lending money out, buying real estate, whatever it is you want to do with your money, all you're doing here, folks, is changing where the money goes first. You're not doing this in place of buying stocks or in place of investing in real estate or doing private loans. You're doing this in conjunction. It is the and asset. It is this and whatever you want to invest in. The only difference is you just found a way to make money twice. And you also found a way to benefit from the infinite banking concept and recycling and recapturing all the money you're giving away. So your goal, well, it does take time to hit that in some cases. But how do you eat an elephant? One bite at a time. How does a man get to the top of a mountain? One step at a time. Is it possible to owe no man nothing? It's not. There's always going to be things you're going to need to buy, whether that's cars or vacation homes or pay taxes, whatever. There's always a use for the money that you save. I just showed you how to make that money work for you instead of working for somebody else. That is all we did. And if that chiropractor that we just talked about continued to make the payments as promised in the old way, back to the banks, here's what he would have paid. He would have paid $879 a month for that condo mortgage, 251 months, that's $220,528, and he would have made his payments to his house, of course, $1,221. He had 224 months left, that's $273,439, meaning he would have given somebody else's bank $493,967. Now, who's going to get that $493,967? His private banking system. But see, he is earning more than 4% on his money. So what if he just earned 4% on all of that money, uninterrupted? You know, the compounding thing. How much would he make? Well, that would change the game, and he'd now have $749,611 in the exact same time frame. Folks, don't ever underestimate the compounding interest and the power of that. But you have to understand that your money doesn't have to sit still to earn it. Folks, if you like what you just learned, then please book a call. There's a link in the description that you can book a call. But now that you know this, everyone should know this. You got to tell people about this, because if you don't tell your children about this, then I think you're stealing from your children and their grandchildren. So please, spread the word. By the way, we never even talked about the death benefit, did we? But that death benefit will pass on to your beneficiaries tax-free someday when you graduate. Not only that, I did mention this, but I'll hit it again. The loans that you took from the policy, well, they don't have to be repaid, because when you graduate or die, the insurance company will true up and subtract the loans from the death benefit. That's how they give you the loans and don't ever need them paid back. The internal values grow tax-free. The policies are exempt from judgments and liens in most states. Come on. This is pretty awesome, you must admit. Warren Buffett would say it like this. He would say, if poor people would just do what rich people do, they wouldn't be poor anymore. And I also mentioned earlier, Will Rogers. I put that up. The biggest problem in America is not what we don't know. The biggest problem in America is what we think that we know that just ain't so. Folks, if you're interested, click the link in the bio, schedule a call with one of our money mentors, or right here on the screen, scan that QR code. That'll get you right over to the link to book a call, or you can text MONEY to 833-217-3854. I hope you've enjoyed this. Now, go out there and take back control of your money and be your own bank. We'll see you next time.